Do you know something? Most of the traders don't actually blow up because they are bad at analysis. They blow up because somewhere deep down they don't believe they'll still be trading 5 years from now. That changes everything. The way you enter, the way you size positions, the way you react to losses, even the kind of trades you're attracted to. Because when someone is thinking short term, survival becomes invisible. And that's dangerous, especially in markets. A beginner usually enters trading with one silent expectation: I need to grow this account fast, not slowly, not steadily, fast. And honestly, that belief feels logical. You look at your capital, you look at social media, you see screenshots, weekly profits, option buying gains, people doubling accounts in days. So naturally, your brain starts calculating speed. How quickly can I scale this? Not, how long can I survive this? That question almost never appears in the beginning. And because of that, most traders unknowingly build fragile systems. High exposure, emotional position sizing, random risk, overtrading during volatility, revenge entries after losses. Everything becomes acceleration focused. But acceleration has a hidden cost. It magnifies mistakes faster than skill. That's the part most retail traders discover too late. Think about this carefully. If your trading system can collapse in one bad week, then it was never really a system. It was pressure. And pressure behaves differently in markets. Under pressure, traders stop following process. They widen stop losses, increase quantity emotionally, hold losing positions longer, take low quality setups just to recover faster. Now the market is no longer being traded objectively. It's being traded emotionally. And emotional trading always looks urgent. That's why beginners often confuse intensity with seriousness. But institutional traders operate very differently. Not because they are smarter, because they think in decades. That changes their entire behavior structure. Institutions don't enter markets asking, how much can we make this week? They ask, how do we remain effective across market cycles? Very different question. One creates excitement, the other creates longevity. Retail mindset: maximize returns quickly. Institutional mindset: protect capital first, compound later. That sequence matters more than people realize. Because compounding only works if survival exists. A trader who makes 40% and loses 60% repeatedly is not progressing. They are resetting again and again. Slow account erosion doesn't always look dramatic. Sometimes it looks like constant restarting. New strategy, new indicator, new mentor, new setup, new hope. But the real issue was never strategy instability, it was survival instability. A structured trader usually operates through three layers. First, capital protection. Second, risk consistency. Third, return generation. Notice what comes last: returns. Beginners usually reverse this order. They chase returns first, then think about risk after damage happens. But institutions understand something important. The market will always offer another opportunity. Your job is simply to still be solvent when it arrives. That's the real game. Not prediction, survival. And survival sounds boring until you realize most traders never reach the stage where consistency becomes possible because they collapse during the emotional acceleration phase. This is why long-term orientation matters, not as philosophy, as structure. A trader with a long-term mindset behaves differently even during winning streaks. That's important. Most people think risk management matters only during losses. Not true. Winning phases are where traders often become most dangerous to themselves. Confidence expands, position sizes increase, rules loosen silently, and suddenly one market shift removes months of progress. Institutions know this. That's why they build exposure limits, drawdown controls, risk governance systems. Not because they're fearful, because they understand uncertainty never disappears, no matter how experienced you become. Here's an uncomfortable truth most beginners avoid. If your entire emotional state depends on one trade, your position size is probably too large. Because structured traders think statistically. One trade means very little, but emotional traders attach identity to outcomes. Win, they feel powerful. Lose, they feel broken. That emotional swing creates unstable execution, and unstable execution destroys long term consistency. So eventually, trading stops becoming a probability game and starts becoming emotional survival. That's when burnout begins, not from charts, from psychological volatility. The market rewards people who can remain stable longer than others. That's the irony. Not the most excited trader, not the most aggressive trader, not even the smartest trader sometimes. Often, the one who survives longest with discipline intact. Because time allows skill to mature, time allows compounding, pattern recognition, execution refinement, emotional control. But none of that develops if the account keeps collapsing. And this is where many traders misunderstand ambition. Wanting growth is not wrong, but growth without structure becomes self destruction disguised as confidence. A professional mindset is not how fast can I make money? It's how do I build a system that still works years from now? Very different energy, much calmer, much more difficult, but far more sustainable. So here's something worth observing this week. Before every trade, pause for a moment and ask yourself, am I trading this setup or am I trading my urgency? There's a big difference. One comes from process, the other comes from emotional pressure. And the market eventually exposes both. Start tracking how often your decisions are influenced by speed, the need to recover quickly, grow quickly, prove yourself quickly. Because long term traders think differently. They understand something most beginners ignore. The first goal of trading is not making money, it's staying in the game long enough to become dangerous.